Economic growth in the Philippines during the first 3 quarters of 2025 has been underwhelming, averaging 5% year-on-year, down from 5.9% in the same period last year. We expect growth to reach around 4.8% for the full year 2025, indicating softer growth in the fourth quarter. On the demand side, household consumption has steadied, but at a softer pace of around 4.9% year-on-year in the first 3 quarters, below the pre-pandemic average of 5.9%. The cumulative 200 basis points in rate cuts by the BSP during the current cycle have cushioned household consumption, while better managed inflationary pressures have also helped maintain purchasing power. Government spending was firmer, supported by the midterm elections in May 2025, but subsequently encountered headwinds from a slew of public construction scandals, which has dampened momentum. The bigger issue has been investment. The election-related public works ban and governance challenges weigh on investment spending, resulting in a sharp slowdown in the third quarter 25 growth, which slowed to 0.1% year-on-year from 3.1% in the second quarter. Scrutiny over public funds is likely to remain elevated, potentially weighing on fiscal disbursement and capex execution. On the external front, exports have supported growth in 2025, largely driven by the global electronics upcycle, which has strengthened electronics exports. Looking ahead, we forecast GDP growth of 5.5% year-on-year in 2026, improving from 4.8% in 2025, but still below potential. This implies that the output gap will remain negative. In 2026, the main challenge could come from the external sector. We expect goods export growth to slow as external demand cools, especially with softer growth in key trading partners such as the US, EU, and Japan. Our baseline sees goods export growth moderating from 10.9% in 2025 to 5.3% in 2026. The new tariff framework with the US may bring a mix of opportunities and challenges. The reciprocal tariff rate for Philippine exports to the US is set at 19%, similar to regional peers. However, some products have been exempted following a November 14 executive order by US President Donald Trump, granting the reciprocal tariff exemption to certain agricultural products, potentially sparing more than $1 billion worth of Philippine exports. There are efforts to diversify trade partners, negotiations with the EU, and applications for membership in the CPTPP and other trade arrangements. But these are more medium-term supports rather than near-term game changers. Domestic demand may remain constrained, with investment spending expected to be mixed in 2026. Government-led capital expenditures will likely remain under pressure from additional scrutiny in the first half of the year before picking up in the second half due to infrastructure commitments. Reinstilling confidence through transparency and reform will be crucial in reinvigorating the investment cycle. Meanwhile, worsening approved FDI inflows suggest that a significant turnaround in investment spending in 2026 could remain elusive. Household consumption, however, should remain firm, supported by robust growth in nominal and real wages incomes. Higher minimum wages, set against a backdrop of well-managed inflation, bode well for purchasing power into 2026. Tourism should also be another strong tailwind, supported by the resumption of e-visa program for Chinese tourist arrivals, which could benefit tourist arrivals in 2026. Additionally, we expect the Philippines Chairmanship of ASEAN in 2026 to stimulate the tourism and tourism-related sectors through the hosting of high-profile discussions. On fiscal matters, constraints are increasingly about governance. Executive Secretary Ralph Recto has noted the ongoing anti-corruption drive could slow economic growth until first quarter 2026. This drive has also coincided with resignations of key cabinet members. The deficit picture remains manageable but still wide. On a 12-month rolling sum basis until November 2025, the deficit stood at 5.7% of GDP. Under the revised medium-term fiscal framework for FY 2025 to 2028, the government is targeting around 5.5% of GDP in 2025 and 5.3% in 2026. Across the forecast horizon, the revised medium fiscal deficits have widened, reflecting mainly lower revenue projections alongside modestly higher expenditures in 2026. Few additional revenue generation measures were introduced in 2024 to 2026, and the key drivers of revenue collections remain the implementation of recently enacted reforms, such as the VAT on non-resident digital service providers and capital markets efficiency promotion, among others. Meanwhile, disbursements will remain focused on bolstering capex over the medium term, but will gradually ease in line with the government's fiscal consolidation agenda. Inflationary pressures have eased sharply in 2025, driven primarily by lower rice prices and energy costs. Looking ahead, we expect headline CPI to rise moderately to 2.5% in 2026, near the lower end of the BSP's 2 to 4% target range, as rice prices remain soft due to the government's vigilance and proactive measures to manage and maintain adequate supplies, while global energy prices are also expected to remain subdued. On monetary policy, the BSP has lowered its policy rate by 200 basis points to 4.5% since August 2024. We expect a prolonged hold through 2026, with the need for further easing reduced once government spending normalizes following increased scrutiny on public expenditures. Simultaneously, a pause in rate cuts will allow the full impact of recent rate cuts to be transmitted to the real economy, providing BSP with some room to assess whether further easing is necessary. Importantly, while rate cuts may pause, liquidity tools remain in play. The reserve requirement ratio was cut by 200 basis points to 5% in 2025, and we do not rule out further RRR reductions in 2026, consistent with the BSP's long-held policy agenda. In summary, Philippines' economic growth will improve in 2026, but still punches below its weight as export growth slows amid constrained domestic demand. We expect the BSP to maintain a prolonged hold in 2026. The key factors to watch ahead are the government's capex execution, external demand, and tariff developments.